Hello, I'm Greg Brown. I'm a partner at Katten Rosenman here in Chicago. I've specialized in employee benefits for 37 years. And during those 37 years, I've spent a great deal of time dealing with employee stock ownership plans, otherwise known as ESOPs. I want to talk to you a little bit about how valuations affect ESOPs. Now, as advisors, we're used to dealing with valuation professionals because our clients, who are private business owners, use a number of estate planning techniques such as grantor trusts, other sorts of estate planning techniques that require the use of an independent appraiser. Now, this will also be involved when they're doing charitable giving of stock. So we're used to dealing with these kinds of professionals, and when we deal with an ESOP, we also need to deal with appraisers because we're dealing with private companies that don't really have a market. And if we're going to be selling shares to an ESOP, we've got to come up with a price that's defensible, both for Internal Revenue Service purposes as well as U.S. Department of Labor purposes under ERISA. Now, who does the appraisals? Well, we have to have a qualified independent appraiser. So this isn't necessarily the company's accountant, but it is someone who's well-versed in the appraisal technologies, the methodologies, and someone who has credentials with one of the appraisal societies. Now, who chooses the appraiser at the end of the day? Well, the appraiser is going to have to work for the ESOP trustee. This doesn't mean that the company would have no role because they need to work with the trustee in the selection process, and it's ultimately the company that's going to be paying the appraisal fees. Now, what does this appraiser do? Well, much like they do with in charitable giving or estate planning techniques, what we need to be sure of is that they're using proper methodology. This is going to involve, going through tax returns, going back through audited financial statements or other financial statements of the company, working together with management to understand what the projections are for the company's performance over the next 3 to 5 years. The sorts of things they do with other types of appraisals. The appraiser is then going to take all of this information that's been gathered and use several different methodologies to value the company. They'll use a discounted cash flow type methodology. They're also going to look at the company on an asset basis, although that's not usually the one that's going to be used. They're also going to look at a capitalization of earnings. They may even look at comparable publicly held companies and value our closely held business of our client using that. And then sometimes they even look at transactions that have been done in the industry with comparable companies. After they look at all these methodologies, they're going to use a variety of assumptions, which need to be reasonable assumptions, and they're going to come up with a total value of the company. After they've done that, then they're going to need to look at, well, what proportion of the company are we going to be selling to the ESOP? If we're going to be selling 30%, then there's likely to be a minority discount in the sale. This may be 10 to 20%, but it's going to depend on the situation. On the other hand, if we're going to be selling more than 50%, perhaps even 100% to the ESOP, then there's likely to be a control premium. And the reason for the control premium is the fact that the ESOP will now have control over the company's governance, its board of directors, and the like. For the same reason, you're going to have the minority discount because the ESOP cannot control the company and its governance, can't even block a merger or sale of assets if it only owns a minority piece of the company. Whether we have a minority piece or a control premium, there's likely to be a lack of marketability discount. Well, what's this about? Well, the fact is that the company doesn't have a market. We can't take the company's shares and sell them readily on the over-the-counter market. We can't take them to a broker or otherwise. On the other hand, the law creates a market for the shares once they're distributed to employees when they retire, because they have a put option under the Internal Revenue Code, which the company has to honor. So what might be a large liquidity discount, maybe 10 to 20%, with an ESOP usually is only about 5% if we have a company that otherwise is able to meet its obligations and has good, predictable cash flow. After all this is done, then we're going to have a range of values which the ESOP can purchase the shares from the selling shareholder at. This is an important process because at the end of the day, we have to have a written opinion to the ESOP trustee telling that trustee that the price that's going to be paid for the shares by the ESOP to the seller is not in excess of fair market value. We need to have this to protect both the seller as well as the trustee, otherwise we'll have what the law calls a prohibited transaction, which entails excise taxes, penalties, and so forth, things that you don't need to deal with. So we need to get a qualified appraiser. We need to make sure that there's a very deliberative process, that appraiser gets all the information, that the appraiser uses reasonable methodologies and assumptions. At the end of the day, have a price that's defensible in case we get audited by the Department of Labor, the IRS, or a plaintiff's lawyer comes along. This is a very manageable process, but it's a necessary process and isn't something that we want to use shortcuts on. Thank you. I think that it needs to be coordinated with the estate plan and the estate planning attorneys, because we don't want to be in a situation where we have multiple values, different values, unless there's reasons for it. For example, if we're using a value for estate planning purposes on gifts to children that are of minority interest, that's going to be a different number than if we sell a majority interest to the ESOP. But I think that we want to have at least consistent methodologies. Now, that gets complicated because the ESOP is going to have its own appraiser for the ESOP trustee. We're going to be using a different appraiser for the gifts because we can't have the same appraiser, otherwise we're going to have an independence problem. Having said that, we need to make sure that the appraisers are not using different information, and they're not using vastly different assumptions, except for what I described, where we might have a minority interest transaction on a gift to a child or a gift to a charity, and we might be doing a majority transaction with the ESOP, and the ESOP might have a different lack of marketability assumption than we would for the other. If we can account for those because of the different situations, but everything else is similar, then we're not going to have ourselves in a position where the IRS is saying, well, you used a vastly different value for this gift than you did for the ESOP sale. Why? So I think it's manageable, but the devil's in the details, and it's got to be coordinated. The first step would be to try to, if we've done some feasibility analysis and we think that the ESOP might be a possible exit strategy or succession planning strategy for our client, then we need to seek out an experienced appraiser and experience with ESOPs. We don't want to get a really good appraiser who's working on his or her first ESOP. We want someone who knows what they're doing, who understands the dynamics, understands what the Department of Labor regulations dealing with fair market values say, and what other little quirks there are that need to be taken into account for an ESOP value that we might not necessarily take into account with other values. So I think the key is to finding someone who's qualified, independent, and experienced with ESOPs.